All right, good morning, everybody. CPI should be coming out any second. Get a reaction from that out of the market, and that ought to be the worst of it for the day. We do have the status report on petroleum at 10:30, which provides a trade opportunity in USO, but other than that, really isn't expected to be very impactful in the market. And then we do have an additional auction again at 1 o'clock today. Yesterday it provided fruitful. We'll see what we get out of it today. Tomorrow is another one. We've got PPI tomorrow and then some job numbers tomorrow. So this is the one, though. This is the one that everybody's been waiting on, and it is the one likely to have the most impact in our marketplace uh, at the minimum for the rest of the week. The amount of impact that we're likely to see here. So, like usual, we want to start out with the expectation. What could we do today? We could maintain the line, maintain the range, or we could expand beyond that, break to the upside, break to the downside. Since a large part of what we're going to get today is directly connected to the PPI numbers, that has to be a part of the discussion. The range we're focused on would be all of yesterday, yesterday's high to yesterday's low. I left that wick off for this box, but there is a little bit of a wick there, that head fake yesterday morning. The line that I would be more interested in for defining our range would be yesterday's RTH open, which for the S&P we didn't quite get to that spot anyways. So this is very likely in a downside move with an ADR of 2.6. If we were going to quote hold the range and we're already at the top of it, then the expectation would be that we work our way back down through these pivot points. We have uh, the close of yesterday, Globex open, Globex low, and then yesterday's low. Each one of them likely to provide some form of impact or reaction in the market. And that could include the Globex open of yesterday as one of those pivot points. Since it ties in so close with these other pivots, though, I don't see any reason to drag that one into the mix. If we measure that out, kind of quantify, would getting to the bottom of the range deplete our ADR? Pretty close, yeah. Oh, shoot. All right, give me just a second, guys. Mr. Marcus needs to go outside. He doesn't realize that it's morning briefing time. So just getting back down to the bottom of the box would be the ADR. A little bit beyond that would be a part of something that would look very similar to a crash and burn in the market. Everything would be lit up for us to begin expanding beyond the low of yesterday. It would look a lot like yesterday's price action, but yesterday's price action didn't have the market breadth behind it. If you were to look at all the tools that we would normally look at yesterday in that sell off, things weren't really lit up. There was no fear behind that, there was no capitulation. We didn't have the scope and breadth behind it. So it would look a little similar to that in its price pattern. But I think if we were to start breaking below yesterday's low, we'd actually light up those market breadths a lot better than we did yesterday. Which leaves the third scenario as a topside breakout. Notice at this point, we got the numbers we were looking for. We did not get a reaction out of the market. Now, there's a couple of theories on why, when everybody is looking for a reaction out of the market and the number finally comes out and then nothing happens. What's going on? Okay, well, the numbers could be a little muddy. At which point they call the nerds and they say, what are we supposed to do? And the nerds got to crunch the numbers, so everybody's on hold. We all wait and let the nerds do their job. The second theory, when you don't get the reaction, any reaction, is that the market had accurately priced what the data was going to be. The data came out and matched their expectations, and we are seeing the results of that. So that'd be scenario number 2, right? It'd be one of those two. So we've talked about staying the range. We talked about the bottom side breakout. It's worth working on a range for yourself. The range of yesterday is fine, but if you were to start breaking the day down into little quadrants or ranges, one piece at a time, it actually gives you a little bit more to work with. So thinking about it from the move at around 330, that rally up, once we broke through the kill zone time frame, that kind of put itself in its own quadrant. Or from where we opened it last night all the way up until the end of the kill zone at 4 a.m., that would be a quadrant. So those two are like this morning's zone or today's zones. Then you could encompass all of yesterday, and that would give you the third one or the lower end. It's easy enough just to mark the whole thing and call the whole thing a range. Yesterday's price action, we're inside of it, we're inside day, we're done. But that doesn't really leave us much to work with. Whereas if you break it down into quadrants, you got a lot more to work with. So for a topside breakout, the third scenario, because we can only do one of 3 things. Linear regression tool. Start near the peak of the last run to the upside. Just drag it across. Now you can see the mid. Then we get our breaks above the mid, below the mid. We're now just coming back right into the mean or the midpoint of that linear regression line. From here, we could reverse and go back down, just like we had that scenario on 520. We had come back through, but instead of completing the swap on the other side, we actually aborted the turn, came back down, and had another one, right? So just because we're at the middle doesn't mean we're going to complete an entire swing high, swing low. It could be aborted, and we just swing back low again. On the other hand, everybody had been talking for the last few days about how bad the sell-off was, and we were at these lows, and when are we going to buy, and isn't it time for mean reversion? And it's time, right? So in that aspect, we do have everybody looking for a little bit of that mean reversion, a little bit of that run back to the upside. It would make sense at the least to reciprocate as much as we dropped. So just draw the line, offset it, put it to the upside. You're looking at about 4,200. Not saying that that would be our target today, more by today, tomorrow, or by the end of the week. And that just completes the swing high, swing low within the linear regression. Take it a little closer than that, though. Kind of focus on what we have for yesterday. So if we do get the rally out today and we start breaking through yesterday's levels, what do we have to work with? Well, we do have that green line sitting there at 4065. That is the high of yesterday. That matches really close with the high of Monday. They're not very far off. Could think of that as a zone. Then there is the Globex of Sunday night. So we had a major pivot at 4090. We actually had the entire Globex high right around 4100. And then there was the gap close from Friday. All of those would be pivot points over our head that would need to be dealt with. We had a pivot minor right around that 4080 area. But with that one, I'd want to bring it in with a volume profile and see if there's anything there that can add some validity to that. So we got this deep, shallow area. Price is likely to move through those shallows areas a lot easier than it could move through the areas with a lot of volume nodes. So we have that volume support around 4011, the cog line. This would be the cog line, 4011. So that's some volume support underneath this. Then we have this shallow area. Price is likely to move through that shallow area a lot easier. It doesn't mean that any of our pivots would be ignored, just that we wouldn't have any volume resistance. We are still outside the box, and there is an expectation that when we are outside of the box, we expect price to come back into the box. And we always want to be asking that question, where are we heading? Are we heading towards the box, or are we moving farther away from the box? And at the moment, we're coming back into the box. When we get back in the box, the expectation is if we're at the lows, we continue to travel up towards the high of the box, and vice versa. If we're at the highs, we expect to travel back down to the lows of the box. The cyan line there is a volume weighted, uh, anchored volume weighted moving average. And its date was set for the first of the year, but right now it just runs 10 days because that's all the data that I've given it. So we would have to get through that. And right now it's really close to the POC. Point of control becomes a little bit of gravity. Should we get too close to it? Question we want to ask is it even within our range to hit? From our current location, that's 2.2, 2.3 away. The market says we're already up 1.25. So we would have to expand beyond our ADR a significant amount. It would be lit up really bright. It should be very easy to see if we're going to make such a move like that. Again, watching the tools that we would normally look for. So when it comes to the data, guys, that everybody's looking for, you can't just rubber stamp some number and say, well, I was looking for 8.2, and with 8.2, the market will rally. It won't work that way. And the reason it doesn't work that way is there are times where good news is good. We're all happy that it was good news. And then there's times where good news is bad, and we're all really upset that it was good news. Because sometimes good news forces the Fed to do things that we didn't want the Fed to do in the first place, or that the market didn't want the Fed to do in the first place. So sometimes good news is bad, sometimes good news is good. And on the opposite of that, bad news can be bad and bad news can be good. So it's not just some random number that we can attach to it. And then you still don't know how they priced the number. 8.2 was the number that everybody was expecting to see. And apparently they priced that in appropriately because we didn't get much of a response out of it yet. And since I'm streaming and I don't know what the number was to begin with, don't know what the results are. I do my morning briefing whether there's an econ coming out today or not. It doesn't interfere or change what I do. For the NASDAQ, game it out, same scenario. We got the range. What are we going to do with it? We can maintain the range, break to the upside, break to the downside. This is the game plan for the day. It's this kind of game plan that helps us determine how we're going to deal with something that we had, say, yesterday. Anybody make money off this run? Because I sure did. I sat around waiting for it into the afternoon and caught that thing and ran it. I got an entire month of day done right there. And yes, I said that. You heard it correctly. An entire month of day done right there. It was worth the wait. Why? Because I gamed it out in advance. We had every expectation that the last econ at 1 o'clock yesterday was going to be a game changer and a significant market reaction. And I played it. Where did it go? Right back up to the pivot point. Destination, goal, target, planned, everything. It did exactly what it was supposed to do, and it did exactly what we would expect it to do. Where do we get that expectation? By doing what we're doing right now, talking out what can this market do today. It can only do three things: stay in the range, break to the upside, break to the downside. Tie that in with the econ of the day. What's our expectations for the day? So we got the numbers. The market didn't give us the immediate reaction that we were expecting. We're going to be opening up near the highs. That gives us a prime setup for a trend day. Not a day where you have trend in the market. That's not a trend day. It's a very specific, very unique kind of day with the little R behind it, right? Like a little trademark symbol that says it's a quote trend day. It's a unique day. It's a very specific kind of day. With a trend day, it would run all the way to 11 o'clock. At 11 o'clock, it would stop running and go into a window, go into a base, a consolidation pattern. Notice we didn't call it a topping pattern because if it's a quote trend day, it can be a down day or it can be an up day. In this case, it would be an up day. One of the criteria for things to be a trend day is that it cannot be inside of yesterday's price action. It cannot be inside of its own Globex price action. So if we come into the open and we are near the top and we can break to the upside, we have the possibility or an opportunity to have a trend day. The reason we focus on them so much is imagine if you can trade a day that looks like this and that you know it's going to be a day like this before the bell rings. Now, we haven't been very we've been getting more of these than we normally would get since COVID. Back in the day, we used to get 3 or 4 trend days a month, a half trend day in the morning, a half trend day in the afternoon. Very often, or very rarely, would get a full trend day. Run till lunch, pause through lunch, and then continue the run on the other side or get a rounded reversal. Those are the 4 different styles of these unique trend days. And we were able to call them before the open, before the bell would even ring. We would know we had the possibility or the opportunity that it was going to be one of those days. You can imagine how much opportunity that gives you when you know it's going to be one of those even before the bell rings. Unfortunately, one of the criteria to do that is volatility. And since COVID, we've had so much volatility that it's hard to distinguish if today is going to be one of those days with as much accuracy as we had before COVID. But we still have the other criteria, things like we need to be outside of yesterday's price action. If we're not outside of yesterday's price action, it's not a trend day. So if you're looking at this and you're thinking, well, isn't that a trend day? No, that's not a trend day. That was sitting inside of yesterday's price action. And that's not trend. Trend has higher highs and higher lows, lower highs and lower lows. This doesn't have this. That's impulse trading. That's one-sided price action. It only went down. There was no buyers. There was no two-sided. There was no profit taking. Same thing with the move on the other side. That was pure impulse, just straight rip in one direction. Not one of our trend days. But we have the capacity today to have one of our trend days if we come into the open and we break outside of yesterday's price action. So we don't have to open at the high and run. We can open off of the high, come up and breach the high and run. It would still be one of our trend days. But we have to make the breach, make the run by 10 a.m. If it isn't done by 10 a.m., maybe 10:05, forget it. You're not going to get it. It's going to have to come after lunch. And very likely after 1, because we do have additional auctions today at 1 o'clock, just like we had an additional auction yesterday at 1 o'clock. There is the possibility for another head fake. So be cautious of coming into the open off of the high, but still near these highs, getting a run to the upside where we tag or breach or touch the high and then dump. It would look very similar to what we did yesterday, where we came into the open, we rallied up and we touched, what did we touch? Yesterday's high. Now, intraday high. We didn't hit it to the penny perfect, but the market opened, made that nice little spike to the upside, got very close to hitting that institutional pivot point, and then dumped on us, right? And then we had the 1, 2, 3 fail and ran her to the downside. So if we come into the open today and we're not sitting right at the highs, but we're off the highs a little bit, and then we open and we continue to widen the gap from the gap close, we continue to go to the upside, look for that fake out breakout, look for that rejection across the high. The banks are still selling the rallies, right? Sell the rip, not buy the dip. They're still liquidating a lot of their larger positions. They're still holding a lot of Apple, a lot of Microsoft, right? A lot of those big tech names, mega cap stocks. So they're still using the opportunity to sell the rip. Just be prepared for that. On the other side of all of this, we've taken a good shot to the downside in the last few days. It would not be much of a surprise to see some linear regression, some move to the upside. So we could still get that. Just watch for that head fake. Third scenario would be that we start to break to the downside and we get through yesterday's price action. To get there, we'd have to get through our own pivot points, then yesterday's low, and then the Globex low of yesterday, right? The RTH low is different than uh, yesterday's low. That would put us at 12,100. And then below that, we'd have to go out to the higher time frames and really start looking around. All right, keep your eye on oil. We're in the rejection spot. Now we've continued to say oil has become relevant again. That's a really good perspective. So oil dumping here would be a little bit of a catalyst we'd want to keep our eye on. Notice the bonds are right back up pressing against those highs. We're not done with bonds by any means, but they were down worse than the rest of the market. So it stands to reason that we're going to be coming back a bit with the bonds. And it leaves the bonds in the same position as stock, right? And what we've been saying for over a week now, stocks and bonds moving in the same direction. That's not normal. It's not natural. It's happened before. We've seen it happen before in history where stocks and bonds stayed correlated for a while, months at a time. But it's just not normal. It's not what we normally see, right? So we're still looking for a decouple between stocks and bonds. We want to see bonds break away and do their own thing. What that would likely look like is if we do get that rally into the open in stocks, that we don't see the same rally in bonds or vice versa, right? That as we come into the open, bonds maintain that rally and stocks sell off like yesterday, right? If you look at stocks and bonds from yesterday, we had the sell off in the stocks, we had the rally in the bonds. That's more normal, right? Not necessarily like a teeter totter that one side goes up, the other side goes down, but still more normal that they're not in sync moving together. We want to continue to see that decouple. And yet, through the morning earlier today, we still had that both of these markets sitting near the high of yesterday. So, position wise, they're looking very similar because position wise, they're both still pretty beat down. Bonds are just down more. Bonds and the dollar, these two are going to be the game changer today. They are what will give you your signals, validate your moves, confirm the breakouts. These two are your game changers, right? These are the best indicators you could put on your chart. Price, time, there's nothing better, right? So when you're looking at price, stocks, bonds, oil, volatility, gold, Bitcoin, look at what you have so that you get a scope of the entirety of the market, not just the one thing you're trying to trade. We want to see this dollar calm down. It's good to see that we're off that 104, but that's not even close to the sell off that we need to see. Right. So we want to continue to see weakness in the dollar, but it needs to be some controlled weakness. We don't want that thing getting out of control and just making exaggerated dumps to the downside. So mark your pivots, watch for the dollar to break through those levels, and you're looking for big volatility bars or big violent price bars. If you look at the market breadth yesterday, this is what I was talking about when we had that sell-off. It wasn't nasty. It wasn't extreme. We've seen this much more nasty than that in the last week, right? Where we've been sitting at full on at the bottom of this thing, pegged out 100%, just staying right at 97, 98, 99, because it only goes to 100, and just being max pain and sticking that level. We didn't have that in the NASDAQ. It was one more reason to believe that we were going to get a reversal off those lows yesterday. Also, look at where it stopped yesterday. It pinned right at the close of the previous day. Solid structure. It held there really nice. And that's the NASDAQ. If you look at the S&P, it was stuck underneath that level. And it was just knocking the door, right? Kicking it again and again and again. We keep kicking the door's going to open. This is the NASDAQ advanced decline. It wasn't negative as bad as it had been. This is the S&P advanced decline. It also wasn't as negative as it has been. It was really confirming that that sell-off yesterday was weak. It was looking for any reason to begin flip over and take the other direction. And that 1 o'clock econ was the final catalyst to get it done. We don't want to say that the catalyst caused that move, right? Or that the econ caused that move, because there's no precedent for that. But that 1 p.m. additional auction has been the game changer day for one of these midday reversals so many times now that it's hard to discount the idea that on a day like yesterday that we weren't going to get some sort of catalyst and some sort of reversal. And that's exactly what we got. And we have another one of those today. So if we contain this same sideways wishy-washy thing that we've been doing for the last 20 minutes, if we continue to stay inside this range, look for the afternoon to provide some sort of an opportunity, right? Believe it or not, the afternoons provide just as much and sometimes more opportunity than the mornings. I rarely trade the open. Usually I'm really busy. I'm streaming or doing something else, managing positions that I've already got. I rarely trade the open, but I don't need to because we got beautiful things like that afternoon move right there. Speaking of the open, I'll see you guys in the large caps.